Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer and today we're going to be analyzing Fortinet stock, ticker FTNT. This one came in by request down in the comment section of one of my other videos. If you have a request you'd like me to take a look at, just put it down in the comments. I will get the ticker on the whiteboard behind me there, and eventually I will make a video. Haven't made a video in a few days mostly because they've been repaving the road in front of my house, so the construction noise has been too loud for me to actually try to record a video. But we're back at it again. I think they have the work mostly done out there, so we can start getting caught up on some of these requests. If you request a stock that's in the S&P 500, I post those on YouTube for free. The rest I post over on Patreon, which is $5 a month to get access to kind of requesting any other analysis you would like me to do. And then if you join there at the $5 a month tier, you also can get a big discount if you ever decide to join the full Cyclical Investors Club service over on Seeking Alpha, and I have those links down in the description. I've had my investing group there for, let's see, we're on our 6th year now, and then I've been writing about investing since 2015, so however many years that I'm starting to lose track. I think this is my 9th year now doing that. And then I've been doing it full-time since 2018, so I've been at this a little while. As always, this is not individual investing advice. This is just how I analyze stocks. So Fortinet is an interesting one. So I'll start this off by saying that I am long this stock, but I'm long it due to my fast growth strategy, which is one of the strategies that's in the full Cyclical Investors Club service. I think we're up a little bit. I didn't double check the dates that I bought, but I think it was during right around here. It was like summer of 2022, so a couple of years ago. I think maybe we're up like 10 or 15%. The returns haven't been great, but at that particular time they were growing quite quickly. We didn't pay too much, I don't think, for it, but we have kind of this consolidation period going on here, which I'll get into. In this video I'm going to switch and use my standard kind of earnings analysis, but I'm going to just kind of estimate what maybe future earnings growth might be. So the problem that we run into here is if you just look at the fast graph here, we don't have recession data from 2009 because it wasn't public back then. Didn't come public, it looks like, until about 2010. So we don't have any kind of quote unquote real recession data. And let's shorten this fast graph real quick to like the current time. So if we just go from point to point here, which they haven't really had, I guess they had one down here in 2017 and one in 2013, but recently it's been nothing but growth for them. So these guys are software company, mostly like security. We see that the earnings growth rate has been like 27% during this time, measuring from like 2010 to 2024. That's compounded, like annual over that time. And then if we shorten this to the more recent time period, which I would do probably like 2016 through now, so the growth rate's actually been 37% for earnings. So they've grown extremely quickly during this time. However, they've been struggling recently compared to previous growth trends. So this year, they're only looking at potentially 8% growth from analysts' expectations, and then 10, and then 13. So maybe teens, we don't really know what the future earnings growth is going to look like. And the past is kind of hard to extrapolate into the future. They had kind of this slower growth period, and then they had a super fast growth period, and now we don't really know where the future is going to settle. So that's what kind of makes an earnings-based valuation analysis kind of tricky. You just have to kind of say, okay, how fast do I think they can grow earnings over the next like 10 years per year? I decided to go with 15% for this analysis, but a person can I don't think anybody really knows. So it's just important to understand that it's just an educated guess. If you use history, it's much higher than that. It's like 30%. If you use what analysts think right now, it's probably going to be closer to like 10, 11, 12%. So I'm kind of just going somewhere in between there with a number that to just get us in the right ballpark of what might be, a reasonable estimate to make on the future. Right now, the stock trades at a 35 PE, which is expensive on its face, but not expensive if they grow 30% like they have been. So the question is, if we assume something in the middle like 15%, then what does this 35 PE get us? So that's what I also really don't really know what a recession would do, whether that would be good. It's just really, really hard to have any super amount of confidence. The strategy that I bought this with is a growth strategy. It's a buy and hold strategy. So basically, I'm locked into this unless it really underperforms over the next several years. And I think maybe I'm bought down around like $50. I should have double checked it. I guess it doesn't really matter. I bought during this downturn at one point. The stock's basically just kind of gone up and down since then. All right, so let's get into the actual valuation numbers here. So I have my 15% growth rate assumption. You can see revenues over 3 years have grown 85%, so they've been really strong. It's just a question of whether they can continue that. Momentum is like average, basically. It's like a C. It's kind of not really doing much. I would actually consider this slightly negative. Like I've ranked at -1 or marked a -1. I like to have like a B-. This is from Seeking Alpha's momentum score. So maybe that's something to keep in mind. I think since whenever you're kind of guessing at earnings growth, you might want to have positive momentum before you buy. So that's something to consider. When I use my growth strategy, which is what I used to buy it with, I waited till the momentum was positive before I bought it. So maybe worth considering, but that's up to each individual investor. So these guys are expected to earn $1. Let me make sure I got this right. $1.76. Yep. So they're expected to earn $1.76 this year. And I have the price at $60. It looks like they have some cash, so I actually give them credit for that. And I have the debt adjusted price at $58 a share, roughly. So when we do the math on that, we get a earnings yield, which is the inverse of the PE ratio. So earnings, which is here, over the price, which I'm using this one, that gives us about a 3% earnings yield, 3.01%. So the way I like to think about this is if I bought the business for $100, they would earn $3.01 on my $100 this year, plus whatever growth. So I gave them 15% growth this year. So I would assume I could earn $3.46 on my $100 investment, and I could do with that money whatever I wanted to. I could go spend it. I don't assume this is reinvested or anything like that. And then what I want to know is if I collected this and it grew 15%, that's the $3.46 growing 15%, not the 103. A lot of times I get questions about that. And I just cumulatively added that up over 10 years. How much would I earn on my $100? So my spreadsheet's set up to calculate that. Looks like we'd earn about $170. We would have $170 on our $100 investment, so we'd earn about $70 more. When you put that in a CAGR calculator, you get about 5.47%. This is about right where the market's at. The S&P 500 / high quality business kind of average. So I would say the market is pricing the business as though they can grow about 15%. I mean, so this is kind of what the market's assuming too, I would say right now, even though analysts are slightly lower than that over the next couple of years. And, this is a little bit more than cash. I think the way to think about this is, and I've said this on a lot of other stocks, the benefit, if a person owned this, which I do own it and I'm holding it, the benefit is they have the potential to be able to one, grow faster than expected potentially, but two, grow at least the rate of inflation, whatever that happens to be. So if we get higher than average inflation, they will have the advantage of being able to pass that along. Whereas if you look at cash right now, it's yielding about 5% to 5.3% in short-term treasuries. I think the 10-year treasury is at 4.4 today. So you have kind of protection there to the downside that you'll get your interest rate. However, there's no inflation protection with those treasuries. Whereas if you have a quality business, you get a little bit more inflation protection, but you have risk that they could disappoint on earnings, in which case the stock price will certainly come down most of the time. And so you risk your principal more with the investment in the business. So, but if everything goes as planned, the market kind of has this all priced out. It seems about the same as the rest of the market. So you kind of have to make an individual judgment on what you think is more risky, inflation or a recession, or some sort of business competitive failure on their part, or failure to deliver expectations of 15% growth a year. To me, this is one where I'm kind of playing both ends. I have an investment in stock like this. That's fine. I'm holding it. I have about an equal amount in treasuries. So if depending on what the market does, I can change that though, right? If we have a recession, I can continue to hold this and hopefully it comes through and I can buy more of something else with my cash. If the economy and inflation or both kind of take off, or even just this industry, then I can capture that growth by owning some of these. So it's not really an all or nothing thing from my point of view. I think if you're buying a lot more growth stocks, you should probably balance that with some cash. I have about 35 to 40% cash right now in treasuries that's yielding over 5%. So I'm kind of playing both sides. I feel like I'm pretty neutral overall, and a stock like this would be one could hold or whatever, I think. Now, is it a buy right now? I don't think so. Not based on earnings. So, or momentum is kind of stalled too. So if you were going to buy it, I think about 40% lower than where it is here, about 36.55 is where I would look to buy based on earnings. That's with a margin of safety. That's not fair value. Fair value would probably be like 20% lower than it is now. So maybe something close to $50 a share. So yeah, that's kind of where I think, if the price fell 20%, it'd probably be fairly valued longer term. If a person didn't feel like they needed a margin of safety, they could buy there. If you want a margin of safety, you want to get down closer to that under $37 a share. So a lot of guesswork in this, and I think a lot of more portfolio strategy too. The thing is, there aren't too many opportunities, and there aren't too many really super high quality businesses that are growing really well. So it can definitely pay to have some of those in your portfolio. That's one of the reasons why I bought this. I did expect them to be able to grow faster than what they've grown. Well, the first year after I bought it was pretty good. You have 37% earnings growth. I didn't necessarily expect that things would kind of slow down as they look like they're doing this year. So I bought it at a decent price, so I'm still doing okay. But I mean, ideally, I would like to see these guys. I should do fine if they grow from 15% from here for a long time. But, there's always the risk these earnings could fall. They could go negative. If that happens, the stock price will get crushed. And, I mean, pre-pandemic, they were $23 a share, so it could lose 50% of its value still from here during a recession. And that's why I think having the cash really helps, because if your whole portfolio is stocks like this, you can just watch the whole thing go down like 50 or 60 or 70% in a recession. If you have cash, the whole portfolio isn't going to fall as much. One. Two, you can actually be buying things when they're cheap, hopefully, and then you can really benefit coming out. So that's kind of my game plan right now with stocks like this. All right, hopefully that helped everybody, not just with Fortinet, but maybe a little portfolio strategy too. I do have a 25% off affiliate link for Fast Graphs down in the description. If you're interested in giving that a try, I think they have a free trial, so make sure to click that link if you want to get 25% off. And I'll see everybody later.